And we do this by fractionalizing the notes. Some people call it crowdfunding. It's kind of a more modern term. But basically, we are taking investors and we're crowdfunding each individual note. So let me first start by telling you a little bit about myself. I was a former financial advisor with Ameriprise Financial. Ooh, I know some of you probably have heard of Ameriprise, but you know, the financial advisory world is a very limited world, and when I was there, there was a lot of things about investing that I didn't know even existed. And I'm kind of an amateur investor myself. I love learning about new ways to put my money to work and make more money with it, and you know, certainly events like this help us all get to that stage. I came to work for Ignite Funding shortly after the crash of 2008, and at the same time, you know, real estate was heading in the tank. I'm sure most of you felt that pain a little bit, as I did as well. But out of the ashes of that downturn, we built a whole new company around trust deed investing, and I'm sure many of you are familiar with trust deeds, some more than others. But hopefully we'll give you a good rounded view today. So let me talk a little bit about Ignite Funding and who we are. We are a commercial loan broker, licensed and regulated in the state of Nevada, and we originate loans all over the country, specifically for real estate contractors and developers. We're highly specialized in that we work with commercial contractors and companies that are in the business of developing real estate in some fashion. So it could be residential, could be industrial, could be a commercial. The types of loans that we originate could be acquisition, real estate development, construction, bridge financing. They really take many different forms. But what they all have in common is that the paper is commercial grade paper. That was neat. Kind of popped off there. So it's commercial grade paper. And what makes us unique is the way we crowdfund each individual loan. So we're not a fund. We don't pool these loans together. We don't leverage the funds. We don't do anything creative. It's really quite simple. We fractionalize the note among a group of investors. And those investors are all listed on the deed of trust according to their fractional ownership. So what that does is it allows us to offer everyday investors a double-digit return with a first deed of trust on the piece of property as security, and for a very short period of time, typically 9 to 18 months are the duration of loans. Last year in 2021, our average duration was about 13 months. We pride ourselves on transparency with our investors, so we'll pretty much share any information that you need to know about the particular loan or the particular borrower, and we are fully compliant with state regulations. And I don't know if many of you know this, being on the east side of the country, but Las Vegas, Nevada was ground zero for the subprime meltdown. And when the Dodd-Frank legislation was passed, the state of Nevada instituted the Mortgage Lending Division of Nevada, which put the clamps down on everybody doing these kinds of notes in Nevada. So we are one of the highest regulated states in the union, and we're now Ignite Funding, one of the most compliant organizations in the state of Nevada. We handle everything for our investors from start to finish. So where a lot of note investors might specialize in a particular segment, we do it all. We source our notes with the borrowers directly. We have an underwriting department that works directly with the borrowers on a regular basis. And we underwrite, originate, and service these loans from start to finish. So we do everything in-house. On the rare occurrence that we have a default and foreclosure, we process that foreclosure on behalf of our investors and sell the property to return the capital to them. So it really is a very passive investment. Originate, service, fund, and defaults. Now, one thing I would like to let you know is who we are not. Many mortgage brokers in our industry will take your money and they'll hold on to your money and they'll reinvest it and just keep sending you the interest checks. We are not a custodian, and the state of Nevada will not allow us to hold your money for any significant length of time. And this is kind of an important distinction, because when you make an investment, you send the money to us. We send you the interest payments every month, and then when the loan pays off, we send the capital back to you, and then we repeat the process on something new if that's what you choose to do. It gives you, the investors, a lot more control over what is happening with your money. So, what is it? Frequently referred to as a trust deed investment, and I've never really liked that term, because what is a deed of trust? It's a legal document that's filed and recorded in the county recorder's office, which ties a piece of property to a note, right? And puts a lien on that property so that lien remains there until the note is satisfied and a reconveyance deed is executed. So it's referred to as a trust deed investment, but what you're really investing in is the secured promissory note, the interest-bearing note that is secured by real property. The notes, again, can take different forms: acquisition, development, construction. We work with a few companies, and I'll get to that in a second, that come back to us again for repetitive financing on different projects. So these are professional contractors that we're lending to, not consumers, and that's another important distinction. So we are able to fractionalize these loans down to a minimal investment of $10,000, which is almost unheard of. But our proprietary database system allows us to do that and still remain compliant. So it gives average everyday investors a chance to put their money to work in something like this. And I like to tell people that we're trying to take this investment a little bit more mainstream to average everyday investors. Geographic diversification. We are extraordinarily flexible, so our underwriting department doesn't get pigeonholed in one type of property in one particular geographical location. We can move around and we can go where the market is showing the greatest amount of opportunity. One thing that's nice about investing in notes is that they're not volatile. The value of the note does not go up and down with the markets. It stays the same, it just kicks off the interest on a monthly basis. Consistent monthly income, which is probably the thing my investors love the most about this, is they get mailbox money every month. By the 15th of the month, that money gets deposited directly into your checking account through ACH, and it's a great way to create a stream of income. Yes?
Can you be LLCs and do this, or does it have to be single, like your personal?
No, you can set it up, well, we'll get to that in a second, but there's a number of different ways that you can set up your account with us so that you can use business entities, trusts, even IRAs. And deal flow. So one thing I hear from a lot of note investors is that there's a lot of downtime for your money in between deals. And we are currently servicing about $320 million worth of these notes. So we have notes that are paying off all the time, and those investors want to get that money reinvested. And so we are originating notes to absorb those payoffs. And at the same time, we're taking on new investors all the time as we're growing. So one of the things that we have to offer our investors is a very consistent deal flow when it comes to opportunities to put that money to work. Just to give you an idea, these are the numbers for the last 3 months, the amount of money and the number of loans that we have originated. So let's talk a little bit about our borrowers. These are a few of the companies that we work with and have worked with in some cases many years. Harmony Homes, for example, in the lower left-hand corner there, we started lending to them in 2011, and they're our biggest borrower as far as dollar amount and number of loans. They're a local home builder in the Las Vegas area. Kind of going down the list, Bel Canto is a private equity fund that develops real estate all over the country. Blue Heron is another luxury home builder. Brass Cap is an industrial developer. Dapper Companies, commercial development. Edward Homes, a home builder, production home builder, but Edward Homes also builds geriatric healthcare facilities in the Southwest, and it's something that's very popular with a lot of our investors. FIG, the Fourplex Investment Group. Now these guys, they build, as the name would suggest, fourplex units, and they sell them to investors, and then they manage those fourplexes for the rental income on behalf of their investors. We do the land acquisition and land development financing for them, and then their individual investors will take us out with construction financing. Harmony Homes, production home builder in Las Vegas. Local Homes, they are a production home builder in Denver, Colorado. And Rhino Investments, they are a leasing specialist. These guys, one of our best borrowers, they've been borrowing from us since 2016, and what they specialize in is buying underutilized retail space, strip malls, shopping centers, that kind of thing. And what they do is they put the properties under contract. They get them the space leased up ahead of time, get letters of intent, and then sign lease agreements, so that by the time they close on the purchase of the property, they already have tenants in tow. And for those of you who know how you value retail space, it's based on the net operating income annually, so that goes up immediately. It sends the loan to value down right out of the gate. Very low risk proposition for our investors. And these are just some of the companies that we work with. There are many others that we are cultivating and bringing forward with opportunities for their businesses to grow through the lending that we provide to them. We believe in having a close relationship with our borrowers, just like we do with our investors. So kind of think of Ignite Funding as the middleman or the broker in between, putting together the financing that these companies need to do the developments that they do, and at the same time, on the other side of the equation, managing the investors' funds to provide a double-digit return for their investment dollars. This will give you an idea of the scope of our business in its entirety. So since 2011, we have grown our loan servicing portfolio to today at about $333 million. We have, since 2011, funded $1.3 billion in loans, and we have done over 1,800 unique loans in that same time period. And we're growing, so it's an exciting time for us. So let's say you're thinking to yourself, well, okay, I got some money that's just sitting in the bank collecting dust, and I'd like to get 10% on it. How do I get involved with you guys? Well, first, as we were talking about a little earlier, there's many different ways that you can set up the account that best suits you, and it really just depends on where the money is coming from. So you can do a self-directed IRA. You can set it up as a pension plan, a solo 401k. You can invest just cash in the bank, set it up as an individual, joint, or a family trust of some kind. Businesses, corporations, general partnerships. And those accounts that you set up will be, and many of my clients do have multiple accounts, they will be listed on the deed of trust with every investment that you make, and we of course provide you with a copy of that deed of trust with every investment that you make. So the way you would start with us is setting up that account, that initial account, and we have an online access to set up an account right on our website, where you can choose the account, you can fill out the information right online, upload any additional documentation that needs to be put in there, like for a business, the articles of incorporation, or for a trust, the trust documents. Once you have an account set up with us, then you select an investment. And right now, we're putting out, I don't know, anywhere from 3 to 6 new opportunities per week. So there's a pretty steady flow of new investments coming and going all the time. And later on in the presentation, I will show you guys how you can opt in for our notifications, so that way you can monitor our deal flow. Once you select an investment, we're going to send you the loan documents for that particular investment. And this is where you have to do a little bit of work on the front end by filling out the loan documents, getting them back to us, sending us the money. Once the loan is funded, the interest starts accumulating from day one. In many cases, Ignite Funding will pre-fund a lot of these loans. So we have our own money in play also, and then we'll assign investors into it after the fact, because we have to balance the needs of the borrower with the needs of our investors at the same time. Once the loan is funded, you're going to get your post-closing documentation, and that is the deed of trust, the executed promissory note, and the title insurance report on the property. Those are your security for the investment that you made, and we provide you with a copy of that on every investment that you make. Then the fun part: sit back, relax, and watch the interest payments roll in on the 15th of every month. Once the loan has gone full duration and the borrower pays it off, usually by refinancing or selling the subject property, your capital will come back to your bank account just like the interest payments did. And at that point, you can choose to reinvest in something new we have to offer, or you can redirect those funds elsewhere. It's entirely up to you. If it is in an IRA account, it'll go back to your IRA custodian, the interest payments and the principal payments. Okay, so we have had situations where a 12% loan gets released, and we send it out by email to everybody, and not everybody checks their email every minute of the day. So we had situations crop up where these loans will get sold out in an hour. We have probably 3,000 investors currently of different sizes. Some of them 10,000 at the minimum, some of them 100,000, some $500,000 at a time. And so what we did is we set up this text messaging service, alerts, that go out first. Whenever we release a new loan, the text messages will go out. And so if you're interested in monitoring our deal flow, you text the word money1 to that phone number. The system will then text you back and ask you for your full name. Type in your full name and send it, and then you're opted in. I can't opt you in on my side, only you can opt yourself in for those text messages. And when you get the text message, there'll be a link in the text message that you can click on, and it'll open up a detailed fact sheet on the project. So I'll give you guys a few seconds here if you'd like to go ahead and do that. But that's pretty much the basics of it. And if you have any questions, I'd like to kind of open it up to everybody and see if I can answer any questions for you.
So you do a lot of construction financing, and typically those are spread out into tranches.
Mm-hmm.
And so are you re-raising for each tranche, or are they just paying for the whole loan up front?
First, let me go back here in case anybody needs that. Yes, we do. It depends on the type of tranche that it is. So there's essentially two types of tranche loans that we'll do. One is a subdivision tranche, where the borrower is taking a parcel of land and subdividing it into pieces. Will actually assign the individual investor's dollars to one of those tranches. It's still cross-collateralized with the rest of them. But that way, every time the builder builds and sells off one of those tranches, instead of getting a portion of your principal back, you'll get the whole thing. So that would be a subdivision tranche. But then there's construction tranches where, like you said, we do raise the capital as the builder needs it. And so the earlier tranches will be the longer term investments, whereas the later tranches will be the shorter term investments. And then when the builder either refinances or sells the property, everybody gets paid off at the same time.
Just curious, kind
Do
of,
the builders have already mortgage commitment for after construction, when you refinance it,
A commitment with us?
with somebody else, or
So-
whoever taking it?
Yeah, sometimes we do the refinance for them, but most of the time, especially once they get to the finished product, they'll get traditional financing because it's a lot less expensive. So our financing from the builder's perspective is very expensive financing. But because it's a short-term loan and because they're using the money to acquire and develop the real estate into something that's more valuable, they're willing to pay our high rates because, again, sometimes they need to move very quickly. So most builders, they're not just working on one project at a time. They might be, half a dozen pieces of property around town that are under contract, and they're going through their due diligence period, and something materially changes in the neighborhood to where now this piece of property has a lot of potential and they need to close on it fast before it falls out of contract. That's when they'll call us and say, hey, can you guys raise the capital for us to get it done quickly? And we have, over the years, developed a reputation of being very reliable as far as showing up the title with the check to close the deal for them. We've had situations where some of our borrowers were able to secure cheaper sources of financing than us, but all they have to do is leave them at the altar a couple of times, and those builders go, all right, enough of that. I want somebody that's reliable, that when they say they're gonna, deliver, they do. And so we've developed that reputation with our borrowers, and because of that, they're willing to pay the high rates of interest that we charge.
so is the tenants all the pass through to them and you just make money on like points and fees, or?
Yeah, so
are you
the,
marking up interest?
yeah, so the note rate of interest, 100% of it goes to the investors. Where we make our money is like any mortgage broker, we charge origination points and loan servicing points, and because we do everything in-house, our investors know where to go when they have questions. Sometimes a mortgage broker will originate a note and sell it off to a third-party servicer, and then he's gone. We don't do that. We manage every single note that we originate and service from start to finish. A to Z, as it were. Yes?
Just so I'm clear,
Uh-huh.
people that get involved, like say, okay, I wanna put 50 grand in,
Mhm.
we're selecting the type of investment we want, right? We're not just saying, here's a bunch of money and then you put it, disperse it amongst whatever things you're funding.
You're correct.
So
Yes.
our risk is in whichever segment that you guys are currently raising money for, right? So like if you're doing home builders or strip malls, whatever's going on in the market at that going time for the next, whatever it is, 12, 18 months, 2
Right.
years, that's our risk.
Correct. Yeah, your risk is subject to that one loan on that one piece of property. Couple of things. So when we talk about risk, there's always the risk of default, right? And then there's liquidity risk. So when you say that the investors do get to pick and choose which investment they go on, yes, they do. And I'm frequently amazed at how I can have one investor say, I don't like raw land, I'm not investing in raw land. And then this next phone call I make, I have another investor says, I only invest in raw land. And so everybody has a different idea. But what I can tell you is that our underwriting department does an exceptional job of valuing these properties. More so than the appraisers and other real estate brokers out there, because one main component that our underwriters look at is the margin that the developer is realizing on the product that they're building. So that's one of the biggest factors that we look at. So this builder comes to us and he wants a loan to buy a piece of land to build 100 houses, and he's gonna sell those houses for X number of dollars. What kind of margin is he gonna be making on those individual houses? Is it, 12% margin, or is it 6% margin? Because if it's a 6% margin, we might go, yeah, I don't know if we wanna get involved in that, because his margins are real thin. If something goes the wrong way on him, he's gonna go belly up and he's gonna hand us the property. On the other hand, if his margins are very rich, chances of him walking away from it are slim to none, because he doesn't want to walk away from his own equity. So our underwriting department does a very good job of valuing the properties up front, and we're typically lending somewhere between 65 to 75% of what we believe the value is. Now, frequently we'll go out to another broker or an appraiser to get an opinion of value. We don't shop around for opinions of value, okay? So we're not gonna go out and get 10 and present you with the best one. We're gonna get one, and whatever it comes in at, this is what we're gonna give you, but we're basing the loan amount on what we believe the property is worth. And about 65 to 75% of that. So we always want to leave a cushion of equity in there to protect our investors. Wow, you guys are easy. Any other questions that I can assist you with? Yeah.
The fact that these are fractional ownerships, does that not make it a security?
It does not, for a couple of reasons. But one of the reasons has to do with the term of length. So we always write our notes for 9 months with optional extension periods on the back end, and those options to extend belong to the borrower. But in most states, that 9 months duration is kind of a threshold. Similarly, they consider this a mortgage product, not really a security per se. So, for example, if an investor wanted to trade his position to another investor, we cannot broker that. We cannot create a secondary marketplace for these investments. That's a matter of state regulations. So we're kind of flying under that securities radar. I don't know, maybe someday that might change, but for the time being, we are, again, considered a mortgage product, private lending, as it were.
Since
Yeah.
it's just a mortgage product, your investors aren't required to be accredited, correct?
Not accredited under what SEC would deem an accredited investor to be. The state of Nevada, who regulates our activity, deems a suitable, and I use that word suitable investor, to be someone who meets one of two criteria. Either an annual household income of $70,000 a year or more for the last 2 years, or a total household net worth of $250,000 or more. And by household, they mean everybody living under the same roof. Now, that's something that you would sign off on in the loan documents and even the application to set up an account with us. However, there's no suitability police out there that are gonna come knocking on your door if you make an investment but you're technically not suitable. So by signing off, you're essentially holding Ignite funding harmless.
It's all certified.
Right. Yeah, there's no real checks to that, but it's just to let investors know, hey, if you don't meet at least one of these two suitability criteria, you might want to consider whether or not this is the right investment for you. And it's the liquidity aspect that's really the issue. I kind of touched on that, but I don't know if I got into that in depth, but because because there's no secondary marketplace for these investments, when you put your money into one of these loans, you're in it for the duration. So if the loan is written for 9 months with an optional 9-month extension period at maturity, and that option belongs to the borrower, your money could be tied up in that loan for 18 months before it matures and it has to be paid off. Similarly, if the borrower defaults on the loan, it could be even longer. So I always caution my investors to approach this with long-term money. And that's why it works very well in IRA accounts. You got a question?
That was my question about if it went into default.
Mhm.
So your money would basically be tied up for the length of, when you get a resolution to that, right? You know,
Sell the properties, yeah.
and liquidate it, not through bankruptcy or whatever.
Yeah, I mean, usually bankruptcy is not an issue because all of our borrowers set up limited liability companies to hold these properties and hold the note. And even if they file bankruptcy, we can usually get a lift stay in 30 days and get the property out of that bankruptcy proceeding. So usually it's doing the time that it takes to foreclose on the property and then the time it takes to sell the property. And then whatever the proceeds from that sale, that gets distributed back to the investors according to their pro rata share of the loan. That's why that fractional interest is so important. Yes,
You ever exercise a deed in lieu of foreclosure?
we have. I mean, it's the borrower handing the property over to us, saying, I'm bankrupt, I'm out of business, or whatever the situation may be, and we will take that property back and market it for sale. That actually happened a lot during the crash. You know, when real estate values plummeted the way they did because of subprime lending, a lot of our borrowers couldn't sell the finished product for enough money to cover what they already had into it. So they're bankrupt. And many of them didn't even put us through the foreclosure process. They said, here, I'll execute a deed in lieu and it's yours, sorry. But we ended up resolving every single one of those properties that we had on our books.
So do you find a good practice to include a deed in lieu of foreclosure on every transaction?
No,
Just in case?
no, the deed in lieu is only used in that specific situation where the builder is bankrupt and they want to give us the property. Yeah. Are we out of time?
Are we done?
I think so.
All right. Did we do good?
If you guys have any other questions or would like to learn more about it, please stop by our booth and we'll be happy to talk to you.
All right, y'all give Howard a round of applause.